friends, and welcome to the Future of Gaming. You're listening to our weekly FOGcast. We've got almost the usual crew. We have Devin, Becker, and myself, Nico, Vereecke. And we have a special guest today, Carlos Pereira, who is a partner at Bitcraft. I work very closely with him on our crypto side. So we look at the Web3 gaming markets. Before we dive in, I'd like to just mention that a few days ago we had an amazing meetup that Devin wasn't at. But so, the reason Phil is not here is because he's flying back from London back to Denver. And yeah, we had an amazing time. So if you were there, thanks for joining. It was really good. We had like 30 or 40 people joining. Talked games, talked also non-related, game-related stuff. It was really fun. And so next up is going to be GDC. So if you're there, let us know and join us. Also, my editor asks me to mention that, if you're watching this on YouTube, press subscribe. If you're watching this on Spotify or another podcast player, do the same. And if you like it, you can also leave a like or a rating. All right, let's dive in. So, Carlos, you and I have talked on a podcast a few times already. But for those of the listeners that don't know you, could you give us a brief background?
Sure. I'm Carlos. I've been an investor since 2015. The early years of my career in private equity, private credit, and also growth at an organization called Eldridge, which is a $40 billion privately held investment holding company with investments in sports, media, entertainment, financial services, including the LA Dodgers and the Golden Globes and a bunch of basically things that everyone has watched. I began building out the games investment strategy there in 2018, scaled it to our first 10 assets, which included Cloud9 and a growth stage investment in Epic and a bunch of other stuff. Then I spent a year at a portfolio company that was having some difficulties with their user acquisition funnel blowing up, trying to help them pivot the business and lean costs and all of that stuff. And then joined Bitcraft in May of 2021, where I've been since. And now I lead the crypto fund here, which is responsible for about a third of our total AUM.
The company that you joined and you tried to help out with their UA, how did that end?
It was a very expensive lesson.
A very expensive lesson. That's, by the way, how VCs communicate. It's expensive lessons, and it's good. Thanks for that. I tried in the intro to think about what we're going to talk about, but over the past 5 episodes, I've said that we were going to try and talk about some things, and then we didn't touch upon those at all. So we're just going to see where this goes, and then afterwards, in the notes, I'm going to put what we talked about. I think that's the safer thing to do. Anyway, Devin, how are things on your end?
Good. My money isn't online anywhere here for the most part, so I'm in a safer place, keeping my investments low. So hopefully you guys can lead the way with the money, so I don't have to. I can just watch from the sidelines, invest in popcorn. But yeah, good. Just finished minting my Champions Ascension Elemental. Had to jump in on that. I guess watch the gas price battle for a minute. I guess there was some in the mint going on at the same time. So pretty exciting.
Fantastic. Are you feeling FOMO for the Pocket Gamer Connect that was going on in London? Not at
particularly.
All? No.
I honestly didn't pay enough attention, but it was it just seemed very focused on maybe a different audience than I was interested in. But I don't know. I think I'm good. I'm waiting for everything to be in the metaverse again. I don't have to go places physically.
Yeah,
I thought this was the future of gaming, not like the analog past we all get together around a campfire of gaming. But
I'll tell you, it was the most attended Pocket Gamer Connect in London, and the venue was not ready for it. So it was pretty terrible.
It's like I had to do an esports event at one of the old Olympic stadiums. It was a DreamHack, I believe, in Canada, and that place was falling apart. It was bad. It was from the Olympics, I think, in the 70s, and was not well held up.
Mm-hmm. Good. All right, let's talk a bit about Web3 VC. Obviously, I have a lot of thoughts there, but I'd like to understand, Carlos, from a founder point of view, that is raising right now, which you and I know there are quite a lot of, right? During the initial bull cycle, there were a lot of very expensive pre-seeds and seeds raised. And additionally, it seems like a lot of teams thought that the bull market was never going to end, and they decided that burn rate. Who cares about burn rate? And they expected to be able to raise at another multiple of their valuation let's say a year later. Seems not to be the case. What's your take right now? If you're looking at the market, what do you see?
I think that this is a good place to try to argue that my very expensive lesson was a lesson at all and not just like a very expensive non-lesson. Because I did have the benefit of being in an experience where had raised a ton of money at a big valuation, product wasn't there with the stage of the financing, needing to go out and to raise money, needing to think about like fixing the cap table because of like how would the round look like post dilution, like all of that stuff. And what I recall is that when we were in the room trying to decide how to approach the next raise, there was a very strong bias against taking the pain on headcount cuts or taking the pain on fixing the cap table before getting that next investor. Because we were like, well, we don't know exactly how much we're going to get, and we don't know at what valuation, and maybe that kind of person would want the organization to be a little bit fatter and grow a little bit faster. And if we do layoffs now, then everyone is going to find out, and no one will talk to us, blah, blah, blah. And the way it played out was, well, one, we ultimately did a bunch of layoffs because we had to in order to survive. It never made the news. Like, no one was actually that important that everyone found out we had done layoffs. Of course, people hear about it at the margin, but like barely any investor questions like, oh, I actually just saw you did a round of layoff. Like, no questions. And a lot of the new people that were coming in, they would be like, oh, like this product looks cool, or the management team is cool, or like there's some cool element here, but I don't have the patience or the time to untangle the cluster that this is before I deploy my capital. And it was very clear that it would have been more beneficial to the business if they had taken the pain up front, if we had taken the pain up front and cleaned up house and said, okay, like, let's fix the cap table. Let's go to our existing investor group and let's basically tell them we will seek a down round at this price instead of waiting for someone else to tell you what the down round should be. The consequence of this, we'll issue these options, we'll do this thing, like all of that. So you could approach new investors and you could say, do you love this thing? Yes, I love it. It's like, okay, here's the price, here's the potential price and structure, but like not, okay, go figure out if this is the one deal that you want to do out of the 3 deals you're going to do and you're busy and like whatever, right? And so the lesson was very much one of biting the bullet early and biting it pretty hard, not waiting for the market to solve your problem for you, not expecting new money to give you like the guidance. And where I see that today is burn. I see that today with valuations. And very importantly, I think we see it today with the deals that only raised tokens without raising equity. Because now, as all those founders come back to market, they have the reality that they're going to have to raise equity, right? Like there's no token only rounds getting done. There's 2 that have gotten done recently, like in the last few months. There were both huge exceptions, and like whatever, the 99% of cases you're not going to get a token round done. All right, so the typical answer, the level 1 surface answer is like, well, I'll just raise equity. And it's like, okay, but like what does that mean, right? Because like now you have one stakeholder that owns this part of your company, another stakeholder that owns this part of the company, and like, are you going to serve 2 masters? Like, how does that work? And it's like you start getting into that question, right? And then there's a fundamental moral and ethical question around it, which is, if you take individual one's money and you create a bunch of value from it, but that value is next capitalized in a different box that an individual has no upside, like what are you going to do? You're going to be like, oh yeah, thank you for your money on the tokens. We're actually going to have to divert all the cash flows to the equity because like we have equity investors now, and it's awesome having your support, and sit there and wait for maybe the token to come out like live one day, right? And like that's obviously a horrible situation, especially when companies need the follow-on dollars because there's very few rounds that are getting done where someone takes the whole thing, right? And so price, structure, and overhead are like 3 areas that a bunch of people are very exposed to, and the ones that bite the bullet the hardest and before asking for someone else to solve the issue, in my opinion, have higher odds of success.
Yeah. You mentioned fixing the cap table. I'd like to touch a bit more upon that because I don't think we've ever spoken about that. I haven't like I haven't looked at enough deals and enough cap tables to be able to like give you a good insight into, you know, what a bad cap table looks like and how you like start fixing that. What some of the approaches are. Could you give some more of your thoughts there?
The core belief is that you should be backing management teams that have so much at stake that they will fight harder and produce more value and not be incentivized to take a corporate gig at some large public company where they can post, here's my routine and my 9 to 5 at Meta and go viral on TikTok, right? Like that's kind of because like, corporate seems to be pretty cushy. I mean, maybe it's getting hard now, but like it was, like a very nice paid vacation for a lot of people. And so it's like, if you're not going to do that and you're going to eat shit starting a startup, then you might as well like be very incentivized for it. And I think that that's the core belief. Historically, seed rounds would get done anywhere between, I don't know, like 20-25% would be an average. You hear of seed rounds that got done much more expensive, like 50% dilution. I'd say like those are more atypical. And every time you're going back out to market to raise Series A, Series B, whatever, you're taking like another 20% dilution, such that by the time a founder would exit the business, they would hold, I don't know, 20 to 40% to the founding team, right? Like I think rough high level metrics. The market at the bull market became non-dilutive funding via tokens, or if you want to think about like, fine, like all the value will accrue to the network. And like you should think about it almost in a pseudo equity sense from like a cap table perspective. It got to 10% dilution, right? 10% of the supply is what you were buying. So as the market reverts, the question is like, how can you raise a down round? There's the anti-dilution provisions, basically a bunch of stuff that relates to it, where it's like, how can you raise a down round or your next round if now all of a sudden you're worth $30 million or $50 million, but you happen to be incurring $15 million of burn a year and you're telling me you need 2 years to finance your game? It's like, okay, so you want to raise like a 30 on a 50 round. Like that obviously breaks the economics of the management team. And so it's that, right? It's making sure that there's stakeholder alignment and that the management team is incentivized to succeed.
Yeah.
I have a lot of questions around a lot of like investment changes. Personally, I don't know if you had something you wanted to go to, Nico, but I'm really curious on a lot of like things you guys are going to have to deal with going forward.
Go ahead, man. We're ready.
Yeah, first question for me is like, so let's say everything gets turned into a security, right? Like tokens are securities now, NFTs are securities now, and like you guys have to continue to invest in games, right? Like how are you approaching that? Then are you just like, well, then let's just make equity deals, or is there, because like for example, a lot of these companies that are companies in quotes starting these games are just dudes out of their bedroom, like calling themselves a company and raising all this stuff and don't have the ability to even handle the paperwork for half of that security stuff, right? And obviously, like the maturity is going to have to get there with a lot of these companies to be able to do these deals. But it's like it can't just be like, we got some tokens, we've got some smart contracts set up to vest this stuff. Like, boom, it's done. How do you guys approach this stuff going forward then?
About half of our bull market deals included an equity component and a token warrant component. Nowadays, about 90+% of our deals are equity and tokens because we've made one basically in the process of making a second exception, but like very much the exception to what we do. And I think that generally is better for a couple of different reasons. One of them is a lot of studios, like if you look at the M&A market or like the exits market for games, a lot of people make a good first game, but it doesn't become an IPO-able company. And you can still get good returns by selling that studio to a large publisher and like all of that. But the nature of SAFT agreements is such that you don't have any attachment to the assets of the business, which means that if you're in the token and they sell the assets of the business, you're only getting paid back if they really want to be nice to you and they come up with a creative way of getting that cash back with, I don't know, buy and burn tokens, whatever, right? And so it doesn't really allow you to capture value for the median case, and it indexes you towards only home runs make sense, or you kind of need home runs for it to make more sense. Whereas when you're in the equity, you can both capture that median part of the distribution of what success can look like, but you can also be flexible with the regulatory landscape where I don't think everything will be a security. I'm not on that camp, but I do think that you will see increased regulation. The only reason why you wouldn't see increased regulation is because we're all wrong, and this whole crypto gaming thing fucking sucks, and no one uses it. And then, like, who's going to bother regulating this thing, right?
Yeah.
But if you actually believe that you're making games that are going to impact hundreds of millions of users, then you have to believe you're going to be regulated over the life of a venture fund. Like, there's no two ways about it, right? And so the question is, how can you create structures that align you with the management team in a way that you can capture value in whatever way the business has to be optimized to comply with future regulations? For example, okay, primary NFT sales are a heavily centralized source of revenue, and therefore that income has to flow to an LLC. But marketplace trading fees, especially if the platform isn't funding the liquidity for it, is decentralized revenue, and you can find a way of buying and burning the tokens for that, right? If you are only on the token, you're basically always having to force fit the business model to where you're attached to value, because like otherwise, why would you care, right? Like that the value is being created outside of your place of capture. Versus if you're fully aligned with the management team, the question is like, how do you make this the best product for the user and the best business model and the biggest it can be? And like, we'll make money like in each of the different pockets in different ways, right? And so that's kind of like why we care about the structure. Now, when I say that 50% of the deals were token-only deals and now it's 90%, it's not like we woke up as a team, as an organization 6 months ago, and we were like, oh my God, like, can you believe that equity matters? Like, no shit, equity matters, right? I come from structured credit and structured equity, and I've done a lot of this personally, right? But if you think that your job is to be deploying capital at a roughly consistent pace and not trying to time the macro too much, in backing the best entrepreneurs that the market has to offer you at each point in time, then that means that you're going to do some token deals in the bull market, because the best teams would never accept equity, and we are there to like fund them versus trying to like not fund them, right? And so, I think there was a quote by one of the benchmark partners. He was like, the best way to enjoy the bad times is to enjoy the good times, right? Just like understanding cyclical nature. And I'll say like the best time for us to enjoy the good times or to enjoy the bad times, right? Like in that, like, yeah, it is bad, but you get paid for it for laying out risk and structure and price. And, it's a good time to be there.
I guess, go ahead.
Well, I was going to say, I've made some notes for myself on like cap table dynamics and what you need to keep in mind when you do so. And so what we need, number one, is to align incentives, right? That, as an investor, if you want to come in, you want to make sure that the investors the incentives of the people that are actually building the business and make the decisions are aligned with yours. The next thing, which is what Carlos talked about, is you need to keep the founders incentivized, right? You need to make sure that the founders still have enough of a stake to keep going. And this could be done through tokens and through equity, right? I mean, I've already made the case that I think there's a world where a lot of the, securities live on chain. And so, for me, when I say this, it's separately from whether you decide to raise equity or tokens. Although I think equity is it's pretty good thing, because there's a lot of rules around it, and that provides a lot of safety and a lot of standards that just make sense for businesses. So we need to keep the founders incentivized. We need to keep investors incentivized. And so as an investor, you don't want to, if you're running $100 million fund, you don't want to invest a ticket of 200K, because then you're going to have to write, what's my math here, 500 tickets. And, you can't spend time. We try to be very helpful and supportive of the companies that we invest in. And you want to have enough of a stake so that it makes sense for you to work with founders closely. And then the most important thing is, and this is also something that Carlos mentioned, is that you want to preempt these same discussions for future rounds, right? Most companies are not able to build a self-sustaining, growing business with let's say with a seed round of 5 million plus a pre-seed of 2, right? They need more. And so whenever you have a cap table, you need to think about, okay, how does this, with the dynamics of this business moving forward, how will we want, what will new investors want to see when they come in, and how will we keep, incentives aligned, founders incentivized, and new investors and old investors incentivized as well. So yeah, these are some of the dynamics here. Anything to add, Carlos, from your perspective?
No, you always do a much better job of being succinct than I am.
Dude, that is such bullshit. This man. every time he opens his mouth, I'm like, fuck, he says that so well. So I'm gonna call bullshit on that. Anyway, Devin, you were gonna ask a question.
Yeah, I mean, it's I guess it's not directly related to that specific topic, but like, I think there's like a kind of changing of not necessarily business models, but like the way that like the money flows. I think in a lot of this stuff, because like with the token model, essentially, venture is basically having to dump on retail to recoup their investment, right? It's like, oh, we get a bunch of tokens. Okay, well, the way we recoup our investment is we sell those to players or speculators, whatever you want to call them. But basically, dumping on retail is the way to recoup your investment with the token thing. Because unless the like you mentioned earlier about buybacks, unless it's buybacks happening from the company, it's not really directly associated with game profit or sustainability of the business or anything like that necessarily. It's more like, how high can we get these token prices before we go to cash them out, and can we do that sustainably along our vesting periods, right? And obviously that's kind of got to shift, right? Because that doesn't seem like it's going to be a sustainable way to do things anymore. So I'm wondering how you align then with profit or with business ownership or whatever you're looking at in terms of how do we get our money back, right? Like there's like the obvious ways of like, oh, we treat it like a loan, right? They pay us back in whether these increments or whatever, and it's more like a loan system, right? Where they're like, they got to make their money because they got to pay us back, right? Or it's like a system where it's like, okay, well, we're taking a part of their profit in some way, like almost like you're garnishing their profit. You're saying like, okay, a certain amount of this profit is diverting over to us, to the people that either own the business in some way or are just owed a certain amount in some way, almost like garnishing wages. Or system where it's like, oh, well, we're looking to get a portion when this business is sold in like an exit or something like that. And it's like, so as there's these different ways of looking at how do we recoup our money as a VC, like what are the ways that you're seeing it shift towards, or you think it should shift towards, away from like I said, the dumping on retail? I know that's like an aggressive way to put it, but realistically, that's how a lot of it went down, right?
I think that realistically, that's how a lot of it went down. But that's symptomatic of a time in the market where it became too easy to launch tokens before launching products.
Yeah.
I don't think that I have any moral issue if we are investors in a game that becomes a successful digital nation where people have demand for currency and influence and governance and assets in that game, that they would acquire that from us in the market. As long as like I feel like they're buying it for a good reason, right? Like that. Like I don't think like if you're dumping on them and it's really like here's some garbage and it's going to go down a week from now, a month from now, right? Like there's nothing here. It's vaporware. Like obviously that's unethical. But the types of experiences that we seek to fund are fundamentally tied to like our belief that they'll have real demand, because like we as gamers make a judgment that like this is a fun experience for a gamer and like we would spend money in that ecosystem, right? And so whether we make money on tokens because those tokens are in demand by participants in that network, or we make money on the equity because that company transacts. And we have, we've been in the business of making equity investments in games since 2016 with the Bitcraft structure. And as individuals, some of us much earlier than that, others like me, like since 2018 in for this segment. It's like, that's part of the business model. Like we make venture style investments in game studios with the belief that they'll either be sold to someone or that they would be IPO candidates. I think IPO candidates becomes trickier with the current regulatory landscape of crypto, because like how do you IPO a mothership that is like super indexed to tokens? And I think like we need more time to say the words IPO and crypto together in that way. But like that's totally viable. Other things like garnishing profits and blah blah blah, like that's not the business model of venture. And so I don't even spend time thinking about that stuff. Like for us, it's like we're either selling the business or we're seeding a network that becomes very popular, and we have assets in that network, and the demand of the assets outstrips the supply, and we get to make that market, or to be part of that market.
So do you think, I mean, the part of the way that works, right, for you guys to have upside on that is for you to be essentially capitalizing a bit on speculation when it comes to the market, right? Because it's when you're cashing out, right, or when you're selling, however you want to put it, you're going to be driving value down or like price down to some extent, right? You're going to be creating sell pressure that is more likely going to be higher than buy pressure, even with high demand, right? And so you're going to be pushing much more towards a real value, right, for the thing, and therefore like it's already starting at a bit of a speculative inflated value to some extent, right? And you're pushing it down. Like I'm talking in theory, right? Obviously, market dynamics can get a little crazy and are maybe not this simplistic, but in some ways, you're pushing it towards real value, and you're basically extracting the sort of speculative, inflationary part of that value, and like maybe that's totally ethical, right? Because like people were speculating, they wanted to speculate. There was demand from retail. Maybe retail was overbuying, and like the demand was overly inflated, like most of Web3 realistically is, where people are spending, thousands of dollars on an NFT for like Dookie Dash of all things, like obviously people are willing to spend for all kinds of crazy stuff, like especially while there's tons of extra money flying around and inflation and all that sort of thing. But like at the end of the day, I mean, I feel like you're kind of, and like, correct me if I'm totally wrong on this take, is that you're capitalizing on retail speculation rather than the business speculation around like an overall sustainable market, because of the way, and obviously vesting periods could be much longer, periods of time, and like that has to be pretty sustainable for you to then even be able to like continue to pull off like speculative parts of that money, like the amount above what the real value technically should be for that thing. Like let's say, let me give an example to make this sound a little less wishy-washy. Is like, say something like an NFT in a game is really like worth like $5, and people exchanging tokens for it, and like they're spending thousands on it in the token or whatever it is. It doesn't have to be an NFT, but thousands for whatever the action is in the game, the sync, etc. in the token, and it really realistically should be about $5. Now, obviously, if people, because there's low supply or whatever, or just FOMO behavior, are spending way more than that $5, and eventually going to drive towards the real value of $5 once like the speculative people go away, you're kind of capitalizing on that difference between like where it's at in the inflated values and what it should be. Because if it was going for $5, you guys probably wouldn't make any money, right? Like, because that's the real value, and you're not going to make profit at that point, right?
I think that this discussion will ultimately be more theoretical than pragmatic, given where we are in our investing cycle and the fact that this type of issue you're describing isn't something that we're dealing with day in, day out. Insofar as discussing theory goes, though, I think that speculation is not a net bad thing. No. I think that speculation can be used to harness virality in a way that's very positive. Like I've often thought about I don't believe that play to earn is a genre, but I believe that play to earn can be a slice of how games economic model works. And in thinking about the earning component of a game, I've reflected on like where those earnings come from, and in particular, drawing a dichotomy between blue collar labor and white collar labor. And the way that I think about blue collar labor is gold farming, stuff that's very repetitive, low skill around it, more hour intensive. And the way that I think about white collar labor are creative fields in which you can extract a brand premia, or basically things that are like less tied to your hours, and you start seeing a decoupling between the time that you put in and like how much money you can get out, right? And I think that if you're blue collar labor, the only chance that you have of high earnings with that blue collar labor is through the speculative premia of applying your labor in a game that isn't hot yet, or in something that isn't hot yet. And I think that that's a totally legitimate way of you incentivizing people to come and to try to engage in the content and to try to make it popular, and basically a marketing driver for that experience. And as long as people understand how they are engaging in that ecosystem, I think it's quite positive. Like for me, let's say I was farming some NFT which real value is $5, and I'm currently selling it $500 in the market. It's like, if the buyers, if you have whales or whoever, people who want to be in there, and there's not like the expectation of like, oh, I'm going to breed too much, although I certainly think it's fine for people to take a risk on that. And over time, that value goes from 500, which is accessible to very few people, to $5, which is accessible to a lot of people and allows the game to scale. It's a good thing that the asset price trended down. And it's also a good thing that early on, some people were able to sell them for $500 because those people probably went and did a lot of marketing and brought a lot of people in and were part of the funnel. Are we monetizing, capturing speculation with our job? I don't know. I mean, at some level, we're speculators, right? We're sitting here with management teams telling us about a vision that they're going to build 5 years from now, or that's going to be delivered 5 years from now, and we're speculating that that's going to be good. So speculation is inherent to the job. But I think more of it in terms of, if you look at what a long-short hedge fund trader does, they'll spend a lot of time trying to understand what the earnings of the business will be. They're not trying to understand what the earnings of the business will be because they want to say, oh, earnings will be $1 and the PE for this company is 16, therefore the stock should be 16. They're trying to say, what are the earnings priced in the market right now, and are these earnings going to beat or miss the market? And I think that the vast majority of investors, consumers, et cetera, if they sit across a management team that says, we're going to build this crazy vision, they would price that at zero, right? They would be like, this is completely out there. And my expectation is that you will miss this completely. And we get paid a lot of money for defining expectations and backing the ones that don't, right? That don't miss and actually build something.
Cool. I was just interested in the thinking behind a lot of it, right? Like, obviously, I don't mean it necessarily in a negative or positive way, but it's like it's the dynamics of how things work, right? And obviously, like, it's different when it's like just going towards retail versus like the stock market, which is a lot driven by retail, but is also a lot of institutional investment too.
I think, Devin, the question, don't VCs that invest in tokens just make money on the backs of retail and their speculative frenzy? I feel like that's probably fueled by some recency bias, right? I think over the past years, that was very much what was happening in many cases. There are a lot of...
I mean, I'd just like to know what changed. Like, where is it going then? Like, if that's the past, what's the future?
Well, I would say that don't forget that VC in crypto is actually really young. And in the end, any type of business takes time to grow to its future cash flow potential, because in the end, that's literally the only thing that matters in any type of investing scenario. That it's what it's all boils down to, right? You can make money on speculative assets. You can make money on assets that are not cash flow generating, but generally, when there's value created, you value an asset at the discounted sum of their future cash flows, right? And so I think what's happening, or what happened recently, was that companies, early stage games, managed to get funded. They had a great story. The retail got really excited about their story, and they felt like they could make money, and they wanted to speculate. And some investors that were in it earlier and were not locked up anymore took advantage of that. But us as investors, like, we're looking for home runs, right? We're looking for companies that will have a network value. Like, if we're investing in a token, our hope is that that token will be worth 100 times as much as the amount of money we put in. And that could potentially, if we're lucky, happen through speculation, that everyone gets really excited and there's not a lot of liquidity. And so then the price goes up a lot. But in general, the best way to achieve that is to let the team work, let the team create value and actually solve a problem. And so I guess my point is that we don't necessarily have to make money on the back of retails that are, fueled through speculation. I think, the way you stay afloat in this business in an ethical way is to, work with great founders that build great networks, that have these, like, can build these, as Carlos mentioned, these virtual nations where people maybe have jobs and do this whole play to earn thing. But the amount of value created there, I think, will, like, a part of that will be captured by the team and the investors. And I think that's in the end what, the best fundamental investing will look like in this space.
Well, then I'm really curious then, like, how it looks towards timelines, because obviously those are going to shift, where, like, we had a lot of stuff just kind of like within the span of 1 to 2 years, everything happened extremely fast. Games growing up, going down, like, hype cycles, things like that. Whereas, like, the real games business, like the real one that's not just fueled by crypto madness, like the one that's been more sustainable, tends to take like multiple years to make games. and games don't usually last more than a couple years max most of the time, right? Like there's a few exceptions, but most games are like 6 months life cycle, right? I mean, I'm not doing the math to say like that's the exact average, but just ballpark, right? They don't last that long. So how are you guys in, like, I'm just asking broadly, looking at timelines? Like, you've got obviously the timeline, where you're investing at, like at the early stages, it takes X amount of time to actually really like come to market if they're not pre-selling and making all their money off that sort of speculation prior to the game coming out. And then there's like that certain limited window in which the game is likely to be successful, because I can't imagine you're expecting most games you invest in to last 5 to 10 years realistically. So it's like, what are you guys looking at timeline wise going forward from here for games?
We think that tokenization exists on a spectrum, and on one end of the spectrum, you have simple NFT implementations that replace skins, simple assets. And on the other end of the implementation, or on the other end of the spectrum, you have an implementation that has fungible tokens, whether it's 1 or 2 token models, whatever, right? But like fungible tokens and like a real economy. So one side looks like, I don't know, castle, like it's like a tower defense game, like something that's interesting enough that like there's good asset economy to that, but like nothing crazy. And then the other end, it would be if you could ever have a game like Eve with crypto. For the games that we've generally invested on the fungible token side, in particular, call it for a normalized market, right? We actually do think that those can be sustainable 5-year plus experiences, right? Like when we're underwriting some MMO, RPG, digital nation type game, like we are making the bet that it will take you 6 months to seed liquidity alone, right? Because it takes time to get people in and to start trading and to do all those things. And we look as examples at a game like Eve that has existed with a great economy for 20 plus years, and World of Warcraft and a bunch of other ones. For games that are simpler, I think that that's where, like, you look at hyper casual mobile and the games last like weeks, right? And so that's where the longevity point that you make, I think, is ever more pressing. And in that case, we wouldn't want to be exposed to a token that has no need to exist. To the extent that there's a token similar to non-fungible assets, the use of them is probably to incentivize your audience to stick with your next title, because that really is like a content mill, right? Where you're like trying to give them different things. And perhaps instead of switching to a new game where your assets lose value, or selling your tokens for a 20% exit tax, or like however you try to gate it, you can roll into a new experience and preserve more upside. And when you're looking at a sector where your day 30 retention is 10% if you're excellent, but like 5% for a lot of these experiences, you take that from 5 to 7% with operating leverage. That's a big difference in earnings, right? And so that's where I think the longevity thing makes more sense, is like using it to retain a broader usage pattern around your ecosystem. I think that's harder with fungible tokens than non-fungible ones.
Do you think there's the situations then where you can invest in a game and it's like, oh, well, if that game fails, those assets might be repurposed, like the digital assets might be repurposed into like another game, the tokens or the NFTs. So it's like you could kind of hedge your bet a little bit that way. Or if it's like an ecosystem kind of investment, or it's like, well, they're gonna do 10 games, and if 5 of them fail, that's fine. We're gonna bet that at least one of them will last for a while. Those kinds of things, because those don't exist right in the non-crypto space, but those have the possibility to potentially like, let's say you were invested in like F1 Delta Time. Obviously it's like, well, those assets are dead now. But if it was like generic race cars, that might apply to multiple race car games, and like maybe not pitching interoperability right at the beginning, but it's like, hey, if that game fails, maybe we can take that invested audience and then try and, like Axie almost did basically with Axie Infinity and then Origins, right? Where they're like, we'll try and take that semi-captive audience, make those assets work in a sort of new game, that sort of thing. Like, is that something that factors in to those time scales?
Yeah, so that's basically the thesis of how we think that crypto fits the more casual end of the spectrum, where it really is about retaining the user over an ecosystem of games. I don't think that those assets have as much value for someone else to come in and like, let me figure out how to build with them, right? To your point about interoperability, but within the ecosystem, when we're making those types of investments, there's generally a story around we're going to make this game and there's like 2 other games in the pipeline. And in general, like we're targeting this audience, female, 25 to 34, they like this kind of game. And, it's basically that.
Cool. Yeah, I'm not a VC myself, so it's like, and I don't even do a lot of investing, so it's definitely a different mindset. Obviously, I've more on the development side and the design side, so it's interesting to think about the different ways of trying to approach it with money, because obviously, I feel like money and business side of things has always been kind of this villain to game developers and game designers, where they've always had to kind of deal with it, and it's like the publisher is on me again, the enemy that's like the necessary villain sort of thing. And it's like, you guys are in an interesting spot as VCs, right? Because you are not controlling the way like maybe a publisher would, or like a parent company, or these sorts of like investments where you're coming in and meddling to an extent, right? You guys are like, well, we just want to make sure we make some money off stuff, and we're just going to do a bit of due diligence, make sure that like you're not full of crap, hopefully, and then we'll sprinkle some money in and hope some magic happens, plant some seeds and all that. But it's like, you guys maybe aren't the villains so much as like as this just kind of maybe you guys could be the wise old man character or something like that. It's like, where do you guys see yourself in that ecosystem with games, especially because it's a different market than a lot of other businesses that are like, say, retail, or even like the digital version of retail, where it's like strictly business proposition. Like there's no art to it, there's no creativity, you're not crushing anyone's dreams. Well, I mean, I guess small businesses can be like that, but you get what I mean, right? Like it's a different business area than a lot of other businesses that, say, VC invests in.
Yeah, I wish we could edit this video to insert that Rick Rubin interview to Anderson Cooper. You know what I'm talking about? It's like he's a big time music business person, producer. He's a very tall guy, long beard, whatever. And this reporter asked him, it's like, so like, do you play any instruments? And he's like, no. He's like, but you can like mix and operate a soundboard, right? And he's like, I have no technical skills whatsoever. Have zero idea of how to do any music. And he's like, then like, why are you the most successful music producer? He's like, I have really strong taste, and artists appreciate my opinion. And it's like, and I say that because it's like, you are choosing a partner to be there in a way that's less hands-on than a publisher, because you don't control the businesses, but it is still ideally because you care about having us and our advice and our experience, like all that stuff. But there's a strong level of taste and subjectivity to it, right? Which is like, am I going to geek out with you on this economy and this loop and this genre and like how you could build this in an awesome way? Or am I disinterested in it? And I think that where we fit in ideally is by backing things that we would love to play, or that we would love to be a part of, or if it becomes more of like the B2B SaaS, whatever parts of the ecosystem, that we have a strong perspective of like why it matters. But like the game investment deals that we've made in the fund that have been like my deals, right? Because everyone on the team is responsible for different things. The vast majority of them have been things that I'm fundamentally sitting here and like, when can I play it, right? Like, when can I go to this thing? Like, I went to an event of a portfolio company like last month, and I was there with them because like I really care about that, right? And that's personally where I'd like to fit in, right? It's just helping people geek out on stuff that I love geeking out on, with the capital markets angle on top.
Makes sense.
I think VCs have filled a specific niche, and I think they're portrayed as a bad guys sometimes. But it's also interesting that without VCs, we might not have a bunch of awesome products that we love and do and play every day. So it's it's an interesting dynamics and some good questions, Devin.
Cool.
Good, fantastic. I think maybe one more, Carlos. You mentioned expensive learnings, and I was wondering, can you share one more expensive learning that you got over the past, like investing in Web3 and games over the past 2 years?
Save us some money to teach us
exactly.
for free.
Expensive is relative, and I say it certainly wasn't as expensive as like concentrated equity positions. But I think that one thing that we're seeing in the current market to be very mindful of is the revenge of the party rounds. And what I mean by that is a lot of entrepreneurs last year approached early stage or token sale allocations as a banker would do like a pre-IPO round. And it made sense, right? Because they were about to launch tokens publicly. But the priorities of doing that are such that you're incentivized in having the most amount of people in your token table as possible because you want to go out to the market and say, hey, look at all these smart VCs that bought this token. Okay. The problem with that is when that next round comes and you're looking around to see who's going to have conviction to do their follow-on investment, to go out there and make introductions for you, to support you, et cetera, when the market turns, no one has enough skin in the game to care about this stuff, right? And like all those party rounds just aren't a party anymore because you're sort of alone with a bunch of people that aren't incentivized to help you. And I think that it's interesting. The market conditions are such that that a lot of party rounds aren't happening simply because a lot of investment capital isn't here anymore, and a lot of tourist funds are now talking about AI or whatever the bullshit they do to follow the winds of the market.
You could say fuck here.
Yeah. But we actually still see it in some of like the really hot crypto stuff where every now and then there's some deal that people get really excited about. And I think that in general, the deals that I've seen strong excitement about, I would say are high quality deals. Like I haven't seen as much, like in the bear market, there were a lot of things that were full of people around them. Now I was like, God, like this is fucking stupid. But like now in general, the things that I'm seeing that are hot, I'm like, okay, like this is actually really cool. Good team, blah, blah. But they're quickly becoming let's raise at some crazy value with 10 different people on the token table and all these angels, all this thing. And it's like people are still searching for that party structure instead of true partnership a lot. Or not a lot, but they search it very often when they have the opportunity. And I would argue that they shouldn't try to do that. And that you're actually better off following long-term benchmarks of raising a little bit on your pre-seed or your seed and then like proving out the product a little bit and thinking about growth and like basically having, you know, if you could, you would have a partner that's an expert in each one of these things at each phase, right? If you think about like the long-term success case of some of these venture startups, it's like, oh, I was doing a B2B SaaS company and my angel was the CEO of Salesforce and he helped me with some introductions. And then I got like a really awesome B2B SaaS VC who had an expertise because the guy had built a business, and I came to the growth round and we were taking the product in this direction, and this GP and this other fund like had invested in, right? Like it was all very tied to like who's the individual, what expertise do they have, like what will this partner add to my board, how do they fit the stage of the company that I'm in, and I think that there's something very beautiful and like good about that, and I think that there was a cheap lesson on a relative basis to be in some party rounds and see them biting back now. And I would hope that people sort of lean off of these things sooner rather than later.
Fantastic.
Good lesson.
Good. All right. Carlos, thank you so much for joining. It's always a pleasure to have you on with your insights. It's really fun. Devin, thank you for joining as well. Carlos, any last shout out you want to do? Where can people find you? And don't tell them your private Bitcraft address because then they can distill from that mine as well.
You can, I was just going to give them your email address instead and skip that step.
That's okay.
I don't know. I feel like it's about time for people to start thinking about GDC. And if you're building and you're going to try to meet with us at GDC, it'd be nice to get that email now instead of March 5th.
Let's plan it in. Yeah, it's a great idea. You're going to be there too, right, Devin?
That's the idea. Luckily for me, I'm closer than most people, so it's a little easier for me to go.
Lucky you, man. Good. Dude, it's like a 9-hour time difference for me, and I'm bad with sleep, so it's suffering, man. So if you see me there, I'm going to apologize in advance for either asking you really stupid questions or just not asking anything at all. In any case, we'll do something there. So if you're there, let us know, and we can hang out. Fantastic. Carlos, Devin, thank you so much for your time, for joining. This was really good.
Peace.
And listener, thank you for listening. I hope you learned as much as I did. And if you did like it, let us know and leave a like or a review. That helps out a lot. And with that, we're out, and we look forward to speaking to you in the next episode. Ciao.
See ya.